Barclays Bank of Kenya has posted an 8% rise in full-year pre-tax profit to 13 billion shillings. This as total income rose 4% to 27 billion shillings. The bank attributes the growth to an 80% reduction in loan impairment charges. And we caught up with Adan Mohammed, who's Barclays Bank of Kenya's outgoing CEO, for more.
Well, first of all, we announced our results today, registered an 8% growth in profit before tax, up from 12 billion Kenya shillings to 13 billion Kenya shillings. That's just slightly over 150 million US dollars profit before tax. It's the results that we are pleased with, given the circumstances under which we operated in 2012, especially during the first half of the year when the macroeconomic environment in the country was fairly volatile.
Your growth in top line was 4%, while your costs actually were at 5%. Why is this so?
Well, the mix of the profit uplift in the year is basically, if we look at the income, we had total income growth of 4%. This is really a mix of different income lines, where we saw the gross interest income increased by just under 20%. And this is a reflection of the interest rates volatility that I talked about earlier on, where rates were very high as a way of taming inflation in 2011-2012. Cost increase is 5%, is way below inflation. I think for a business that continues to grow and invest, below inflation cost increase of 5% is commendable. But what is really important for us that we pay a lot of attention to is the cost-income ratio, which has remained flat at about 51-52%. That is a number that we pay a lot of attention to going forward, and we shoot to see that number coming to slightly below 50% in the near future.
Your loan impairment was down 80% to now stand at 14 billion. Are you taking a cautious step in your lending?
Our gross lending has been in excess of 50 billion shillings. But because of the repayments that we have, the net figure looks significantly lower than that. So we continue to be open for business, and lending will continue in this market. What we've been very conscious of is to be careful about the quality of assets that we put on, especially on the consumer side, when interest rates are extremely high. We've seen, when inflation gets high, not only does the cost of living increase, and therefore people's ability to put food on the table gets challenging, but to actually service consumer debt becomes that much more difficult. So we've got to be aware of that. And I think 2011-2012 played a big role in the size of consumer loan that we built, but we didn't stop lending. We're just conscious, we just tightened the criteria a bit more to make sure that we don't get short-term benefit of putting up more assets, but having to deal with longer-term consequence of high impairments later.
Recently, the Capital Markets Authority granted approval for the transfer of 3.7 billion Barclays Bank of Kenya shares to Barclays Africa, which is largely owned by Absa. Explain to us this One in Africa business strategy.
Well, this is a really exciting development for us in Barclays, not only in Africa, but in the group as well. We have operations in many countries that are subsidiaries of Barclays, including Absa. And last year, the Barclays Group and board took the view that, look, these business units that are run like fiefdoms just need to come together under a common management structure. What this is going to do for us is, as Barclays Kenya, to be part of what will be the biggest bank in Africa in terms of customer numbers, in terms of distribution footprints, in terms of strengths and capability that we can deploy in different parts of Africa as opposed to specific countries in the past.
How do you plan on tackling the recently launched Central Bank of Kenya's prudential guidelines on increasing capital in order to minimize on risks?
Well, the new prudential guidelines that were announced by Central Bank will come into effect 1st of January 2014. And what that does is it's going to basically require banks to have sufficient capital, not only to deal with credit risk issues, which has been traditionally the case, but also now try and provide capital to support issues arising out of market and operational risk. In addition to that, central bank here locally has built a buffer of about 2.5% on the minimum capital requirements. But the great thing is we are in a very strong position as a bank, very strongly capitalized. And today we announced an 11% growth in underlying dividend payments that we do. And that will still enable us to meet those requirements into the future as we continue to grow our business.
Lastly, Adan, we are a few days away from Kenya's general election. Are you bullish or cautious in this period?
Well, I think generally we open our eyes to what is happening in the marketplace and see how we can guide our business operations accordingly. And so we are cautiously optimistic as the noise and the campaigns actually go on, that we should be able to put this behind us quickly and focus on our business. So no change in direction. Of course, the anxiety level within our customer base for longer term projects, that exists, and that's only natural. But we feel reasonably confident that things will get back on track and the political noise will reduce, and managing the economy along the lines of Vision 2030